All right, so let's kick this off. Good afternoon, everyone, and thank you for joining us for today's webinar, the Institutional Digital Assets Playbook. I'm Manal Amin, founder of DiligenceVault, which is a platform adopted by allocators and asset managers globally to digitize and streamline diligence workflows. We are thrilled to host this timely conversation on the institutional adoption of digital assets. The webinar will roughly last 45 minutes to 1 hour. We will be largely doing a lot of panelist conversation initially, and then if you have any questions, please send them in via the Q&A section, and we'll try to take it throughout the webinar. And also towards the end of the webinar, after the webinar is completed, we will be also sending takeaways along with the poll results. So thank you very much for everyone who is participating in the poll, and we'll leave this open until I have a bit of an introduction of everyone, and then we'll kick off the webinar panel discussion and an overview as well. So as a context, over the past few years, we've watched this space evolve tremendously. From the rise of tokenization, stablecoins, and new payment rails to a regulatory environment that continues to transform quite a bit. In fact, I don't know if you guys have seen the SEC examination priorities that came out recently for 2026 has a reference, but it's definitely not a direct reference to this asset class. Now, with growing institutional participation and development of on-chain funds and tokenization of private markets, there is a real momentum and also real diligence needs to navigate opportunities and risks in this space. So today we will be focusing on a lot of those topics. And we're very fortunate to have a distinguished panel that brings perspectives across product innovation, regulation, practical implementations, and due diligence. So starting off, joining us today is Andy Martinez, who is founder and CEO of Crypto Insights Group, a research and intelligence platform guiding institutional allocations in the digital asset space. Andy brings nearly a decade of buy-side experience as a crypto portfolio manager and fund founder, having diligenced over 500 managers globally. Next, we have Laura Vidiella, Head of Investor Relations for Digital Assets at VanEck. Laura works closely with institutional investors and capital markets on VanEck's crypto strategies, drawing on her background in trading, risk, and business strategy. She's also a board member of Women in Blockchain. Next is Roy Ben-Hur, who is managing director at Deloitte, where he leads the firm's digital asset financial service practices. Roy has over 2 decades of experience advising global financial institutions on risk, compliance, and technology, and today he helps clients integrate digital assets, tokenization, and blockchain infrastructure into mainstream finance. And last but not least, Win Molina. Win is a chief operating officer and head of ODD at Crypto Insights Group. Win has over 20 years of experience in investment operations and risk, including leadership roles at Bitwise, Northern Trust, Mercer, and Barclays. He's a recognized thought leader who's spoken at events hosted by Bloomberg, the CFS Society, and AIMA. All right. So as we kick this discussion off, I wanted to pass it on to Andy to show an overview slide and share his insights about evolution in this space.
Great. Thank you, Monel. Thanks for having us here. We're really excited to be presenting to this institutional audience. I'll take 2 minutes and start at a high level on how institutions have really gotten digital asset exposure across this space. The path is quite sequential. It began with venture funds building the early foundation, attracting most of the institutional attention as it clearly fit into an existing portfolio bucket of the institutions. Hedge funds then started to emerge with real trading infrastructure and risk oversight, although have remained quite small on a relative basis in terms of sizing. From there, we saw the rise of regulated ETFs in 2024, which now hold roughly 150 billion in Bitcoin and ETH exposure. And it really has become the most comfortable entry point for traditional allocators. And most recently, we've seen the emergence of what we call digital asset treasuries, which are vehicles that hold underlying digital assets, but pair that exposure with an operating business model. We saw a major wave of these come to market over the summer, and allocators are watching, that category very closely. What I would say is exciting here is that we're at a point where there's quite a few ways to get crypto exposure depending on what you're looking for. The second piece is the active management landscape, which is where we spend most of our time at Crypto Insights Group. On the directional side, we see allocators increasingly looking for quantitative managers who can outperform Bitcoin on a risk-adjusted basis. And then separately, fundamental managers who can actually demonstrate real selection skill, not just market exposure. On the non-directional side, the bar is rising as allocators compare these strategies directly to traditional hedge fund portfolios. They're really evaluating stability, consistency, and whether the alpha is durable across market regimes. And then very lastly, the evolution of the space has really been shaped by what institutions need before they can allocate. What they are looking at first is operational readiness, meaning that the fund or strategy can function with the same, if not higher level of control, oversight, and predictability that they'd expect from any other asset class. They also want investment clarity. So the mandate is unambiguous, reporting is intelligible, and the risks are measurable. They care about team quality, which really comes down to experience, decision-making process, and whether the organization can scale. And then they need clear benchmarking and objectives, because without a way to contextualize results, it's impossible to size or justify an allocation internally. So the big takeaway is that institutions are moving deeper into digital assets, but they're doing it with a higher bar that needs to be met through the same frameworks that everywhere else they use. And that's really what's pushing the industry to evolve. Back to you, Monel.
Thanks so much, Andy. I think that's a great overview of how the institutional interest has evolved. Maybe, Roy, I'll start with you to see what you are seeing and how you're advising your clients, especially as there is the investment landscape and there is also the payment rails, regulations, and tokenization as you're talking to your clients on implementations around those areas. So how would you compare and contrast what Andy's provided as an overview?
I mean, a lot, and thank you, Manal. Kind of aligned to what Andy kind of showed, right? So if we go back circa a year from now, when we began seeing approval of ETF in the space and the move of it, but I think the major shift, what we see started with the new administration and the focus of the new administration on broadly on blockchain digital assets as an innovation technology that's driving it, aligned with kind of their push to broadly tokenize the market. So again, at the high level, kind of driving two agendas. One is payments, which is driven through the Genius Act, as you noted, right? So Genius Act became a law, signed into law by the president in July 18 of this year, but really provided alignment in terms of payment stablecoin, which will be backed by will be approved to operate in the US, backed by one-to-one by US-based assets, which will go live anything in the timeline of November to December of 2027. Sorry, there's a long leeway to get there, but the market is already reacting and building rails and building capabilities around it. So that's one area. I think the second area that what we have seen, at least on our side, is the broader tokenization around that. So clearly, we're waiting for the formation of the market structure from both the Senate and the House. But at the same time, what we all see is kind of the SEC and the CFTC progressing, providing clarity, specifically the SEC Project Crypto, which provide guidance to firms who are trying to innovate and build rails around it. So again, aligning to what Andy is saying, now you've got the cash leg solved predominantly through Genius, and potentially getting the tokenization leg either through Project Crypto, what the SEC is trying to do, but hopefully through a market structure bill that will come over the next couple of months.
That's helpful, Roy. And then, Laura, how are you seeing the investor interest? I mean, from your perspective, because I think we've talked about the evolution of the market, the changes, regulations, but how are you seeing the investor interest transform in this space?
Great question. Actually, a lot of things I agree with most of the things that Roy said. I was going to touch on a few of those, but it's shifting in different ways, right? Like I think there's been different waves in the cycles and how investors have invested early on. Maybe you had a few institutions that were a bit more risk takers and they'd a bet on like buying Bitcoin themselves directly spot physical. Mass Mutual is an example. They bought about 100 million back in 2020. We don't know if they've sold the position or not because there hasn't been a disclosure, but if they haven't, it's about $500 million today, right? Same with other endowments and other pension funds, right? And then back then there was a lot of more interest in the venture side as opposed to on the liquid side. Now they're shifting a little bit because some of the venture investments haven't really, there hasn't been that much DPI, partly because back then a lot of the best founders, or not best, but great founders had left crypto because there was not a strong administration that was like backing them, right? Now we see a lot of them coming back and building really interesting projects. So it's another interesting side on the interesting wave on the venture side, but specifically it comes down to their liquidity preference, right? A lot of them now are seeing, okay, with the ETFs, I can actually manage my portfolio a lot more actively, and I don't have to be tied to this venture lockups. I don't have to be tied to even sometimes the liquid lockups that they're not okay with even a month or 3 months of lockups, right? So it really comes down to the strategy of liquidity strategy of each one of the institutions, their plans, or if they're trying to hedge against the dollar, if they have a bucket that's more innovative and they want to allocate more into that front. So it goes case by case, but we're seeing a lot more institutional interest this year. And for me, it also includes the RAs and the financial advisors that up until this year, they were not really having conversations. And that's very interesting.
And then do you have a view on, say, I think the two types of product innovation that has happened. One is traditional assets in a tokenized wrapper, and then a tokenized and digital asset into a traditional wrapper, which is the ETFs, versus the others more like tokenized funds so that it can be distributed in a different way. Where do you see the interest, at least from the institutional space, growing?
I think for a lot of the tokenized assets, the issue here is that we're still building the infrastructure, right? So having something like Bitcoin wrapped into an ETF, it's great because they have it already in the hands of their prime brokers. It's already in their stack, so they don't have to think about any additional onboarding. That sometimes is a bit of a headache. While maybe the investment team wants to do it, that has to go through the IC, that has to go through a compliance team, and it takes a little bit, right? So it's great to see these wrappers because it promotes the institutional adoption. But I'm also interested in seeing new businesses or the more established crypto larger companies that are tapping into this institutional crowd and trying to onboard them directly also in their stack without, kind of like moving them away from their traditional stack and seeing if they can also accept this one, right?
Thanks, Laura. And I think now pivoting to you, Ben, I think Andy mentioned initially that allocators are expecting the same level of institutional quality in the operations of these funds. How are you seeing the funds mature in that space? And then part two of the question, what role can industry players like auditors, service providers, custodians can play in just building that investor confidence?
So what we're seeing is that the managers on the liquid side, so the hedge fund providers, the SMA providers, and quite candidly, even the ETF providers who automatically need to be registered investment advisors are being forced a lot further up the curve from a regulatory perspective than the VC managers. I think that's a function of a few things. One is the fact that, when you have liquidity, and more importantly, when you're starting to manage kind of the pool of assets that most of these liquid providers are managing now, there is automatic, regulatory registration either called upon them, depending on what they're managing, or more importantly, because of the fact that they may be trading things that are via exchange, because we do have instances now where there's actually crypto that's in various forms of equity. Could either be, as Andy mentioned before, we have these digital asset treasury companies. There's, although private, they are equities. There's pipes that are out there. There's SPACs. And so what that's necessitating is that on the liquid side, they need to essentially conform more to the regulation that's in front of them, whether it's the SEC, in the UK, the FCA, or other global regulators. I would also say too that because I think a lot of people in the industry, in particular institutional investors, are much more concerned about the liquid managers from the perspective of counterparty exposure. I think that's forced their hand, where both managers and crypto counterparties have been forced to conform more to industry standards, and that also leads itself to regulation. Using the largest example that most people are probably familiar with, I think FTX forced the issue quite a bit amongst the institutional space within crypto, where again, counterparties needed to understand or very quickly conform to regulation or subject themselves to it. That way, they could get institutional investors to work with them, predominantly being investment managers, and then the managers themselves are now being born to assume the standards of being registered with the SEC, meaning not necessarily register with the SEC, because if they're below the regulatory AUM, obviously they're not obliged to do that, but conforming to the standards insofar as that many institutional investors have forced the issue of counterparty due diligence, both initial and ongoing. And so that's really raised the bar there. Where on the VC side, just to provide the contrast there, obviously that's a lot less of a potential issue because of the fact that although many crypto VC managers do have liquidity in their books, because as tokens unlock, there is liquidity, they still, as Laura mentioned before too, based on how they distribute these things, they're not necessarily subject to the mandate and the standards that the liquid managers would be subject to. To your second point about the service providers raising the bar, again, I would say in the post FTX world, as I mentioned, counterparties, meaning crypto brokers and exchanges, needed to really raise their standards as mandated by the continuity of desire from institutional investors. But we've seen that in the audit side, the auditors have gotten a lot more experience of working with digital assets now that we've had a bunch of cycles within crypto. And just so everyone is aware, crypto cycles tend to run much quicker than traditional markets. So it kind of forces everyone's hand. So the auditors are getting better at things such as valuation, at actually conducting audits. Where there is still a bit of work to be desired is, as I'm sure you can imagine, with a number of crypto strategies, a lot of those tend to be high frequency in nature. And so when an auditor is doing their job, let's say they're doing, the audit of financial statement work for a particular fund, a lot of them still have a bit of catch up when it comes to having the technology to be able to pull in samples to do testing, because just the vast number of or volume of trades can be pretty daunting, but they are getting better at that. On the fund administrator side, I would say that it still remains that a handful of administrators really have the lion's share of the fund admin business. There is one administrator in particular that probably, in my view, probably has about 70-80% of the market. Having said that, though, again, because of the mandate of big institutions starting to invest in both liquid funds and in VC funds, it's now causing the administrators to conform their processes, conform their services, and even again their technology to be able to handle crypto books. And so therefore that's also raising the standards, aligned with the point that most administrators, when they're onboarding an investor or an LP, right, they're normally conducting AML and KYC as part of their service, in lieu or in conjunction with the manager. And so because things have changed from a regulatory perspective in terms of upping the standards of AML and KYC on the crypto ecosystem, and then crypto investors, that's also caused the administrators to kind of raise the bar there and get a lot better at doing deep dive due diligence on crypto investors. And what I'm saying there is not the traditional institutional investors that are really clients of DiligenceVault. Think of like pensions, endowments, and RIAs, as Laura said, but more crypto foundations, which is a newer type of entity, but they are a significant institutional player because they themselves are managing pools in the billions of dollars. And so as they look to invest in things such as crypto hedge funds or crypto VC funds, predominantly to stay within the ecosystem, then the AML and KYC standards for who those foundations are or the DAOs associated with them requires a little more information with regard to transparency. So overall, the point is that the industry is moving in the right direction, adapting on really a month-to-month basis, but evolving over at least the past 5 to 7 years.
Very helpful, Ben. Since we've talked about what are institutions looking for, maybe Andy, I'll go back to you saying, how do you see the role of digital assets in a diversified portfolio? We've all talked about liquid strategies as well as venture. How are you seeing from your perspective, how are allocators thinking about the balance between the two? Because it's pretty much a barbell strategy from a liquidity perspective, but a very different yield characteristics as well.
Yeah, it's been really interesting to see kind of how different types of allocators are thinking about the asset class and where digital assets really fit. We have an interesting vantage point because we talk with everyone from family offices who are a little bit more nimble to some of the largest institutions globally across the board. Some are, have more investment committees and operational committees that they need to get crypto across the line for. What we've noticed is in terms of underwriting crypto exposure on the venture side, that's probably the easiest for them just because the bucket already exists, right? Like it's a sleeve that's known. Once you make the decision, the liquidity is, X amount of years later, which is actually quite nice and it's easier to underwrite. So it's more familiar. And in fact, there are some of these venture funds that focus on not just token investments, but also equity investments in this space. So it's even a higher level of familiarity relative to a token-based investment. I think more on the hedge fund side, we've really seen an inflection point over the last, I would say 6 months, because originally when we saw allocators start to ask questions around investing in hedge funds, it was just, what are the hedge funds that are outperforming Bitcoin, right? And that's really difficult for many hedge funds just to outright outperform Bitcoin when there's like very high highs and very low lows. And what we've noticed is when Bitcoin's up a lot, the institutions are saying you need to outperform Bitcoin. And when Bitcoin's down a lot, the conversations start to go away. So it's kind of a catch-22. The reason why we think we've seen like an interesting inflection point is because institutions are now saying, what are the funds that on the directional side that are outperforming Bitcoin on a risk-adjusted basis? And that sort of starts to show the level of sophistication of the types of questions and interest, because it requires sort of that second order level of interest more than just how do I get exposure? It's how do I get thoughtful exposure to the space? We're seeing crypto becoming approved more from a policy perspective within larger institutions. And we see a lot of excitement from US institutions themselves that doesn't really get talked about enough, I would say, in the crypto space, because there's been a level of exhaustion, sort of false promises that people have told themselves within the crypto space since 2016, I would say. There've also been a couple other narratives I touched on in the first slide that I showed, these digital asset treasuries. We've seen, various levels of interest from large institutions. I would say there hasn't been a lot of uptake from them. It's more of the family offices that have been participating in these shorter themed waves. But what I'll say generally is that the venture funds have a clear fit in an institutional portfolio. The hedge funds are increasingly finding a way to get into there, either to compete with the existing hedge funds like the long short equity tech funds, or if there's like a little bit newer, part of that sleeve is now towards crypto, it could be a quantitative directional strategy. So what I will say is it requires a little bit of workshopping, and we're definitely kind of in the early stages of that, but we are seeing large institutions trying to find a way to make that work. And we see policy allocations being planned for as soon as the first quarter of 26 in a pretty sizable way.
Can I actually jump in and also add a couple things that Andy made me think of? But one thing that we see a lot, especially with like the latest institutions adopting digital assets, is the first thing they think about, all right, how should my exposure be? Why should I hold? Where should I invest? Most of them drift into, I should hold for sure 1-2% Bitcoin, because they compare that to gold, right? And hedging against the dollar and whatnot. Then the second step is like, what else can I do? How do I get exposure to everything else? And that's when they try to decide if they're going to do venture or liquid, and then they go down into like how each one of them operate. At least that's what we're seeing. And then it's also interesting when it comes down to some institutions like larger family offices or anything like that, depending on how the family build the wealth, they're more towards venture because that's what they understand and they know best. Or if it comes from a more financial background, they're more comfortable with like hedge fund structures and venture structures.
So that's very helpful, Laura, just breaking down that stages of allocation. Maybe I'll ask a question back to you on this. What are the difficult questions institutional allocators are asking you as a fund manager? We've covered how are allocators looking at this product, but I'm probably going to ask you from a manager perspective, what are the difficult questions that you get asked?
Yeah, I think in line with what Andy was saying, obviously when price goes up, a lot of them pick up the phone. And then suddenly it's like, how can I get exposure to all of this? And many of them end up saying, maybe I do a basket of different tokens. But if you see any index historically, they haven't performed well. You need an active manager that is able to like move capital around. So trying to get them out of this idea of, hey, maybe a basket of tokens is not the best thing. And for them, it's easy because they think of like, well, but the S&P 500, I get exposure to, a basket of like everything, and it's performed fantastically over the past like 20 years, right? So why wouldn't I do that? But yeah, it's trying to explain to them basically, and this is, I guess, a bit of a review. Most of these tokens, they don't have that much support in the back, right? What's interesting is investing in managers that actually see also where value is created elsewhere, right? Now you see with stable coins, there's a lot of equities that are leveraging stable coins within their infrastructure. So look at managers that are doing that, because you don't want to be in a position where you're stuck with only tokens, and then you see it every cycle. Most tokens go down 90 to 95%. Then all the work that institutions did to like get comfortable with digital assets all of a sudden is gone, right? So these are a bit of like the tough questions or tough conversations that we have to bring up to institutions. Sometimes it plays against us, right, in what we're trying to do, but we're trying to educate everyone and say, hey, make sure that you consider all of these different aspects, because it will happen in a bear market that if you're only exposed to tokens and an index, is not going to work in your favor.
And that's a very good point. So I think that brings me maybe back to Roy's. As we think about product innovation, and this is a new asset class with a higher amount of volatility, how do you think about investor protection evolving in the regulatory landscape?
So actually, I'll take a step back, because Laura used the term digital asset, and when we use the term digital asset, it's more than just your Bitcoin and Ethereum, and that's, I think, one of the issues that we see across the board, across the industry, is when you say digital asset, people think about those two asset classes mainly. But underneath that, you have your tokenized private funds, you have tokenized equities, you have tokenized bonds, which are mainly another representation of an existing assets that just sits in another wrapper, right? Call it a digital twin, or call it a natively issued, right? And I think that's kind of the fundamental issue. I think, speaking about allocation, yes, you've got the allocation into what I call the crypto coins, which is one. But then if you're a fund now, can you potentially invest in tokenized private funds that you couldn't do before, because their allocation was higher than whatever the fund allowed? And that exists today already, and that's one of the benefits. Now, going back to your question, because I went a little bit off, is clearly what we see right now is the notion of use this, and from the regulatory side, we want the industry to use this to drive innovation. We want the industry to look at it and view this as a way to moving the financial markets or the capital markets in the US into, I'll call it 22nd century, or whatever you want to define that. But at the same time, and I'll actually heard the speech from Chair Atkins last week on November 12th. He made a speech, and he clearly spoke about that. And he said, while we are driving innovation, we're still maintaining customer protection. And his point was, and I'm kind of trying to reference him, if you're issuing a token promising to build a network, and then you disappear with that money because you're planning to do something else, the SEC will go after you. So net, customer protection is still being kept. Whatever you're doing, even if you are assuming that you are not under the SEC preview, you probably need to do the right diligence, consult with the right lawyers. Clearly, more clarity is coming out on that right now with the build out of the sandbox and a number of other items. But still, need to make sure that, going back to what Vincent mentioned earlier, right? You do your AML KYC requirements, and then you may meet all the other customer protection requirements, because that's not going to go away. It's still a requirement. And the fact that this is now a tokenized version, either Bitcoin or Ethereum or an ETF or any other tokenized manner, it doesn't take that responsibility away.
Absolutely. And I think I'll pivot a little bit because I think you mentioned private fund tokenization, and we did see a recent announcement where there was a collaboration between JP Morgan and Citco. So as banks, large asset managers, large custodians deepen their involvement in digital assets in general, where is the biggest talent gap emerging? Are a lot of people who are experts in this space going to go work for these big organizations? Is it going to impact technology, compliance, product design? Vin, do you want to take it, or anyone else wants to comment on that?
I mean, speaking of my personal journey, and not saying this is the case for everybody, but I was in traditional finance for many years, well, almost 2 full decades. And for me, having an operations background, blockchains and crypto made sense because I saw kind of where the hockey puck was going, and I wanted to go there. Being on this side now, what I'm beginning to observe is that I think that the traditional players, meaning the banks and some of the asset managers that are just starting to get involved in this space, missed an opportunity within the past, I'll call it 5 to 6 years, where they could have or should have built out these teams to be on top of this stuff, either in terms of creating operational efficiencies within their organizations. Like JP Morgan's doing that. They have their Kinesis team, formerly called Onyx, that does a lot of things internally for JP Morgan, where they're able to obviously move around assets or conduct transactions in a more efficient way. But when it comes to investing in this space, and Monel, to your point about the talent that's there, I think that a lot of folks in crypto are either natively part of crypto, and they don't really have a particular interest, whether it's philosophical or otherwise. Maybe it's just about having the ability to build things that you normally wouldn't be able to get in a large bureaucracy. I don't see a lot of them moving over. Um, and what I see is a lot of catch up from the traditional side, trying to either ask people to advise, or even putting job postings out there directly to pull in people to create new digital assets teams. But I'm seeing a disconnect in between those that are the actual practitioners versus what it is that these groups are trying to build out. And as we all know, and as we've seen, throughout the years, some of these big groups may just take out an entire organization or two just to set a build it, buy it, right? But I think another point that's important to be made here is that as time goes on and you have the folks that are kind of on the cutting edge of a lot of these things that are out there, not just from a mechanical perspective of like, does a blockchain make sense for a transaction, but think about the new types of investments, and I guess I would actually say probably securities are out there. You have things called like perpetual futures and perpetual swaps. That's a newer concept that was really born out of crypto. And so although that may feed into the traditional brokerage and security side, probably in the near term, within the next year or two, it really is the crypto set, meaning crypto investment managers, crypto portfolio managers, crypto operations people that are involved in those and understand how those work a lot better than the traditional side. On the other thing, on the other note that I make with regard to a contrast between the traditional and the crypto, and where there may be a gap there too, just understanding the mechanics of how crypto works. So, for instance, when I'm conducting operation due diligence on a crypto manager of any type of strategy, whether it's a liquid or a liquid manager, I still need to understand how they actually hold and control these assets, whether they have self-custody, whether they're using third-party custody. Are these DeFi assets that are on a decentralized exchange versus a centralized exchange? And I still find that a lot of people on the traditional side have a hard time understanding these concepts, but they are coming, pretty hot and pretty fast. So I guess overall, what I'm trying to express there is that the traditional side is going to have a bit of catching up to do, at least for the next year or two. But as they get more involved in the space, I'm sure that'll kind of even out.
I'll come over, Laura. Sorry, Laura. Monel. Totally agree with what Vince said here. I mean, if we go back 5 years, and we've seen some muscle memory that was built with some of the traditional players in the space. What actually happened post 2022 is a lot of those traditional players, because of what happened in the market and the broader market reaction, kind of decided to de-engage themselves. And because of that, they've lost that. So that if you start from the product side, understanding what the tokenization digital asset could help the products, that's kind of lost. If you think about the technology, exactly what Vincent mentioned or Vin mentioned is, what do you know about building? which networks, which layer one you want to operate, what's the differences between each and every one of them. And clearly what we have not spoken about is your risk and compliance functions that now needs to build those skills to understand what do we need to do. Vince spoke earlier, again, I mentioned AML and KYC. How do you use blockchain analytics tool to understand what the movements of money? How do you make sure that you understand the custody component? Who has the keys? How the keys are being managed? All of those questions, all of those skills will need to get built up. But I will say, I'm encouraged to see that we're moving around that. For those who follow, I believe yesterday, OCC allowed banks now to start paying or start holding start holding crypto coins to pay for the gas fees, which means now that within the banks, their teams will be allowed to hold, if they are not, to start holding those assets, start touching those assets, and paying for those gas fees, again, within reason, within risk appetite. So that's the direction of travel, but I agree with Vin, you're looking at 2 to 3 years of building that muscle memory in the bank, in the different institutional players, to make sure that they understand exactly, going back to my point, what are those assets, how they operate, and how do we manage them end to end?
No, thanks, Roy. I think that's very helpful. I think a lot of us are still learning and constantly learning, and this is a space that's evolving very quickly. If there are any questions from the audience, please throw them into the Q&A chat. Otherwise, we'll look to close out our discussion, which has been taken a lot of different perspectives from the panelists on the panel. So thank you so much. Now, we talked about different levels of maturity that is happening in different pockets, whether it's talent, whether it's service providers, whether it's the allocators themselves building that maturity. What do we think is going to be an inflection point for institutional adoption? What would we be? It will be a regulatory milestone, a product innovation, a macro trigger, or a couple of smaller things coming together. Maybe everyone can opine on that?
I'm happy to get it started, but I think at this point it's definitely product innovation, right? On the regulatory, yes, we have the Clarity Act, hopefully finalizing soon. Genius Act, we'll see how the laws apply. There's a lot of things that are moving forward and I think will be done. I don't think the discussion is there anymore, but what else can be done, right? I think stablecoins was probably the biggest innovation that we've had within crypto digital assets. So now we need to see this into other verticals, right? An example that we like to talk about, Denek, obviously besides the ETF, we have tokenized assets, we have venture fund, liquid fund, and digital assets. But one thing that excites us from tokenization, besides tokenizing our own products, for instance, is what else can be done, right? We talk about faster settlement, lower fees in all of this, and that's to be seen because it's not fully applied yet. But what about other innovative things that you can do with tokenization? What about rewarding your users with tokenized equities, right? These are the things that we'd like to see, like to think about, and I think that's what's going to bring interest again back into, or more interest into digital assets. What's mainstream? I mean, I think digital assets in general is a little mainstream, but I guess my last hot take on all of this is that we talk a lot about digital assets and crypto as a word, but if mainstream is really going to happen, we're going to stop talking about these two terms like that. It's just going to be embedded into our systems.
Yeah, if I could jump in here. So first off, what I think Van Eck does particularly well is that they have a whole suite of investment products for the different appetites that someone might have when they want to enter into the space, from like the passive to the venture to the active liquid side. I'll speak to what we see from the active manager space, which is the sophistication of fund managers themselves is evolving pretty quickly. And we see that as like an interesting inflection point on top of like everything that's happening on the regulatory side and the macro stabilization side. We're seeing on the market neutral front, better frameworks for capturing these like structural inefficiencies. The market changes a lot. The market structure changes a lot. So managers need to be quite nimble. On the fundamental side, we're seeing clear narratives emerge around what actually constitutes a fundamental. On the token side, it's a little bit more clear what constitutes a fundamental on the equities side for crypto. But it gives managers more of a concrete basis for trading conviction. I think generally what the underlying all this is like rigorous education. We just need to constantly help institutions lean into the space, and it's not just the macro, it's a lot of grassroots work.
I mean, I'll come over. I think personally, I believe, as I said, I think Genius Act was the watershed moment. Again, think about the first digital asset regulation in the US, the first major financial institute regulation since Dodd-Frank. Now we are looking for, and hopefully it will pass, a comprehensive crypto market structure framework. Once that is available, that's a watershed moment, because then you got both the assets and the cash combined. I will actually, and we probably need to spend another time on the White House, digital asset plan that was issued in July. And if you align to that and they understand where the direction of travel, again, trying to drive U.S. leadership in this space. That's what the direction is. And again, I'll echo what Chair Atkins said in the end last week, and he mentioned that the fact that he doesn't want the fear of the past to hold us trapped looking at the future. So once we get those two regulations, well, and I think I agree with what Andy said and Laura, right? It's not a one moment. You will see increased adoption. And as that adoption creates, as we have a secondary markets to start trading assets, that hockey stick moment will happen, and it will happen fast. And I think that's what we're telling to our clients. You just cannot wait on the sideline to wait for that to open, because they'll react. Going back to our earlier points, you will need to find talent at that point. You will need to start getting, and it will most likely be too late for you. So just sitting around waiting is not a strategy that I would advise any of my clients.
Wayne, do you want to add anything else? This was pretty comprehensive view. Otherwise, we can take some of the questions.
I'll be quick because I know we have questions. I want to take Laura's point about product innovation and take it a step further, and this is something that's somewhat topical. I think one of the interesting things that crypto has to offer is new types of financial products. I mentioned some before on the security side, but more specifically, there's a lot of opportunity to kind of find, for institutional investors, new yield-bearing type of instruments that are there. I think a lot of people are familiar with the concept of staking, where you could take, I'll use your Ether as an example, that's a token based off the Ethereum blockchain, and be able to essentially pledge that back to the network, where it could be essentially reused and you earn a yield off of that. But there was recently some news about what's called vaults and curators. Just to touch on that for a second, and shameless plug for myself, I'm going to do an ODD blog on that very soon, so stay tuned. But what we found there was that there's this new burgeoning type of product that exists where you have essentially groups called curators, which are for the most part are asset managers that essentially take their product, be it a fund or some kind of collateral they manage, and they're able to create a vault with infrastructure providers called vault providers, where essentially you as an investor in the vault could earn yield on that by pledging certain assets. And essentially it's a pool like any other, where you're exchanging of assets and you're earning a yield off of that. There was some issues recently where one of these pools, the collateral was not essentially deemed to be of enough substance, and therefore it kind of bottomed out the pool, and therefore the vault had a bit of contagion going on, where a lot of people were hitting the exits. But although that's a negative thing, the positive thing is that crypto is now providing an opportunity where there are other ways to kind of earn yield or return other than the things that we all know that we've talked about so far, meaning investing in securities, investing in funds, investing in private structures. And I think that crypto is really going to pave the way for really just a brand new kind of class of different types of financial products, and really opening of more capital markets than we've seen before, which gives people access, whether individuals or institutions, access to new markets and new forms of earning a return on investment that hadn't existed before. And to me, that's probably the most exciting thing.
No, thanks, Wayne. I think great point. First question that we see here is, any key learnings from 10th of October, which was a massive flash crash in this space, and probably one of the largest drawdown events. Anyone wants to comment on that?
I will answer that, and I will
Yep.
say you need to look at the past to understand what we've learned in traditional securities market, and say we need to apply it to the digital asset market, right? If we would have had trading halts that exist in our traditional markets for years, some of that stuff would have stopped. I will also add another example, right? We had a major outage on the technology side that happened, I believe, a couple of days after, and it goes back to the resiliency of our network. So if you're operating your layer or your exchange on a single network, then you don't have resiliency. That's another lesson learned. Point I'm trying to make is the key learning is we need to look at what exists today in the existing SEC and other regulation and see how can we make our existing market more resilient to address that. And that's just one example.
For active managers in crypto running liquid strategies, yes, it was like a pretty crazy event, but they are used to this. Risk infrastructure and risk management is tested in crypto every single month, probably every single day. There's increasingly set of like high quality providers that are helping these managers themselves manage that risk instead of them needing to build these systems all internally. You know, crypto has been battle tested in so many different ways. What I'll say from the fund manager perspective, because we see a lot of like how these funds have performed and how they're communicating to their LPs, is that we were actually very surprised, like pleasantly surprised with how both market neutral funds and directional funds fared during this process. I think the key learning from us is it's not really a learning, but it's a reminder that, you know, these are opportunities to present like a masterclass in communication. These are opportunities to build trust with your LPs, and we still see many funds falling very short in this respect. So the key reminder is if you're looking to invest in a crypto fund, like, yes, they should constantly be meeting this high bar that you expect from your other funds outside of crypto itself.
All right, great answers. You're right. We'll move to the next question. Are the fund managers of open-ended crypto funds registering with the SEC as investment advisors or ERAs? I don't know if anyone has that stat. If not, I believe it's both, but I think Winner, you came off of mute, so maybe you address that and I'll follow up.
Yeah, I'm just gonna go based on my observations without backing up with any hard stats. Yes, some of them are, but many aren't because, quite frankly, they don't have to. So we need to take a step back and just understand that where I think a lot of us that come from the traditional space are used to most managers being US managers or European managers that are subject to US regulation. There are many crypto managers that operate completely outside of developed markets and their regulators, meaning they're operating offshore, which is fine because they were kind of forced to go there based on the nature of what they're trading as a crypto asset and the very exchanges that offer that. And so what I'm saying is that they don't necessarily have to register, especially if they want to trade certain strategies or certain types of financial crypto instruments, because the only way they could get that and effectuate their strategy by the end of the day is being able to trade offshore and therefore not have US investors. So it's a bit of a mixed bag. It's not so easy. It's not so black and white to say, oh, well, you should register with the SEC or the FCA or the Hong Kong SFC because, you know, we've all seen over the past few years some of those regulators push back on not wanting to really have regulatory oversight unless there's an issue going on versus keeping up with the technology and the products, as I said before, of being able to, you know, help these managers implement their strategy in a good, clean way that has guardrails and regulations. We have seen some managers in the crypto space that tend to trade more US books or with US clients, register mostly with the NFA as commodity pool advisors. Again, there's still kind of that gap in terms of what is a security in crypto, what's not a security, and therefore which regulator has oversight of that. And so because that's still there, that's another reason why we don't have many managers just automatically becoming registered investment advisors with the SEC. And the last point I'll make too is that a lot of managers are relatively small. I mean, they're only managing millions or maybe tens of millions of dollars. They're below that regulatory AUM threshold, and therefore they may have to register with a state regulator, but they're not getting pushed into automatically registering with the SEC unless they volunteer to be an exempt reporting advisor just because they're below that threshold. So it's a mixed bag, but it's nothing nefarious. It's just because of the way that a lot of these organizations operate or their size and scale.
Ben, just to back your last comment, and I just got this from your slides earlier and I wrote it down. I thought it was interesting. 10 billion, the total AUM of liquid funds, and there's 1,000 of them. So that gives you an idea of the threshold.
Excellent. Yep.
No, great points, guys. I think one thing we can follow up with is, DV sits on a lot of the ADV filings, so we'll pull the numbers based on self-reported ones, and we'll share how many are IAs versus ERA. So we'll definitely share that in the takeaways. All right. So next question is, what are the most crucial areas for compliance to focus on for an institution seeking to move into the digital assets tokenization space, pending additional guidance from regulators and/or Congress?
I mean, I'll take a stab in. Feel free to chime in after. I mean, clearly, if you think about compliance, making sure that your broader risk framework is updated to align with the different nuances of the product or products you're going to deal with, right? And make sure that you're still meeting your risk compliance requirements. And then if you break it down clearly, AML, KYC, again, being able to understand where those assets are. Item related to the broader management of the asset itself in terms of how keys are being managed. This is more on the operational compliance related items. And then clearly, depending on what product it is, you may need to also look at market manipulation or market oversight. And again, have the skills to apply the required risk factors that you need to look at from market manipulation behaviors, just making sure you've got the right tools. So those are at least the crucial items. Let alone that you follow through around investor protection from a compliance perspective, making sure that any communication you're making out to your clients around that, if you are, you're still maintaining investor protection, you're not violating any rules around that. I'll stop there, Vin, if you have anything else to add.
Thanks, Roy. Listen, compliance touches everything, so I'll come up on maybe two or three that I think, in my observations, are pretty crucial that I think probably needs a little more tightening. One is from the personal trading perspective and oversight of that. I think that a lot of crypto managers had the view of the policy that because these things were not technically securities, and again, to my earlier point, because they weren't subject to or immediately subject to regulatory oversight, that they were not paying as much attention to employees' personal trading. I would say that needs to change quite a bit insofar as that if employees are, and I'm not putting a debate in terms of trading securities, which we know for sure is black and white, you need to have a restricted list and pre-approve all that. I'm talking about just employees trading in conflict of their clients, meaning the accounts or the books that they run. If they're trading the same assets, that's not a great look. And so, we at Crypto Insights Group often advise managers to, if they don't have a policy, create a policy, and if they do have one, make sure it's tight and that they are pre-approving client employee trades, at least for certain cryptos, like the largest tokens that are out there. Another area for compliance that I think is a bit more heightened that they should focus in on is, as Roy said, compliance related to controls, meaning who has the ability to access or control transactions. As we stated before, example, if there's self-custody, who has control of self-custody, especially if it's a physical wallet. There is technically self-custody with third parties that are out there, but who has the ability to transact that? Do we have multi-signature authorization? Common things that a lot of people are used to on the traditional side, but applying it in a crypto way. And then the third point I'll bring up from a compliance perspective that I myself have kind of had many conversations with managers about is compliance with regard to pricing and valuation. A lot of firms have not written down what their pricing and valuation policy is, and it causes a lot of back and forth between them and their administrators or them and their clients. And so I think that's another area of maturity from a compliance perspective that managers need to conform to or get better with, which is having documented policies and procedures of how assets are priced, especially if things go liquid, as tend to be the case with a number of crypto products or investments that are out there.
Thanks, Ben. I think great, robust responses. And I think we've got three questions from Herschel, so I'll probably combine all of them together. What global macroeconomic factors are driving rise of tokenization of private and in some cases the public assets? And then how are institutional investors, or are institutional investors using volatility and allocation target percentages and time to hold these assets with respect to their total portfolio?
I mean, if you think about
Questions,
the
yeah.
underlying premise for this, Monel, efficiency gains. So that's kind of macroeconomic. The ability to introduce new product through potentially fractionalizing those products using, I'll say that I'm not speaking about blockchain digital. Sorry, I'm not speaking about Bitcoin. I'm not speaking about tokenized assets of them. Programmability, atomic settlement, all of those benefits, both on the front side, getting new products out there, or on the back end. So those are kind of the macroeconomic driving it. If you think about Europe with MiCA, which was a regulation enacted about, give or take a year and a half ago, 2 years ago. Now that thinking about 2.0, that's driving adoption there. Again, as I mentioned earlier, in the US, what we are seeing right now with the push from the regulators and administration towards either market structure or clarity from the SEC and SEC of what we can do, those are the macroeconomic that are driving it. Clearly, the US as the major market, if we will move the world with us, I'll say that. And again, if any of my colleagues have anything to add about kind of is broader other questions as well.
I will add on the tokenization side. I think one aspect that maybe smaller crowds or retail crowds are very interested in, that also covers institutional crowds, is the tokenization of private company secondaries. And Robinhood made an announcement back in July that it's available for European customers, right? And that created a lot of noise that also expanded into other exchanges that are looking to the same thing. So I think that's one of on the tokenization front, a very interesting item that we've been exploring a lot. When by we, I mean the industry. And we're trying to figure out what's the right way to make it compliant, because maybe the setup that is announced right now is not the best way to go about it, but it's one to keep an eye on.
All right. Anyone wants to take the institutional allocation based on targets or volatility targets, or even the diligence that happens in manager selection with respect to ESG agenda or allocation governance framework?
Yeah, sure. I'll just hop in here and just to talk about the
Yeah.
ESG and governance diligence. It's more about process and transparency than anything else. They're not really expecting crypto to solve like climate or social issues. They're kind of looking for evidence that the manager operates with integrity, controls, a clear decision-making framework. They're really focusing on the governance side, like board, GP structure, segregation of duties, conflicts management, risk and controls, transparency and reporting, responsible investing alignment. And so the ESG angle for crypto is really about the governance quality and the operational maturity. Allocators are in large institutions, they need to see a thoughtful framework. They need to see documented controls, and a manager who can evidence that they run a business in a very institutional manner.
Well,
I can add to the allocation one, if it's helpful, but I think it depends. It widely depends on the allocator or the institutional allocator and how the CIO likes to manage your portfolio, right? It often comes down to, hey, we have 50 basis points that we want to put into more risk on assets, and then or they want to put into something that's more hedging the rest of the portfolio, right? So that's often like how they think about it. Another way is it depends on how they underwrite the particular investment, and sometimes they want to underwrite it more in a venture style way for like 5 to 10 years. Sometimes what we see also now is that given the adoption on the hedge fund side, and a lot of hedge funds are touching also equities now, that could overlap a little bit with the other hedge fund, the traditional side that they're invested in. So they're trying to figure out how to fit that within their model, right? So it's been great for the institutional adoption and for all the asset managers and hedge fund managers in crypto, but at the same time now we're also competing a little bit with the other side of the world.
Perspective. Anyone else wants to add anything else? Otherwise, I think we are past the hour. So a great discussion. Thank you all, Andy, Laura, Roy, and Win, for sharing all of your thoughts and practical insights today. And thank you to everyone who joined us and contributed questions to make this a very interactive discussion towards the end. Thanks again.
Thank you.
All right. Take care, everyone.